Hello, my name is Vicki Stylianou and I'm the Group Executive for Advocacy and Professional Standards at the Institute of Public Accountants.
Tony Greco, Senior Tax Advisor at the Institute of Public Accountants.
So Tony, you just got out of the lockup here in Canberra for the federal budget. It was a much anticipated federal budget with a lot of big tax changes. Most of them we knew about. Were there any actual surprises on the night?
Yeah, I think the pre-1985, if you're looking for something that was not expected, that was one particular aspect of the CGT changes that no one saw coming. Effectively, people who held those assets are currently exempt as of the 1st of July 27. They will be subject to CGT on the gains thereafter. So there will be a cost base uplift, but yeah, CGT changes were well muted. Indexation will effectively be the way forward. There will be some transitional relief for those who currently hold CGT assets, but indexation will be the way forward, and that will introduce a bit more complexity, unfortunately, which a lot of our members will have to deal with. So yeah, negative gearing is also was one of those things that was well muted, and yes, we did see those changes come through. Not too many surprises, but there are a few things that in the detail that will surprise people. One in particular, if you demolish an existing and replace it with one dwelling, that will not be considered a new dwelling. Things of that nature will come out in the detail, but those changes effectively they were earmarked to happen tonight, and they've followed through. The other big one was in relation to discretionary trusts. We knew they were looking at a minimum distribution. The pleasing aspect will be the fact that they start on the 1st of July 28. There will be some measures to allow existing users of discretionary trusts to transition into a different structure. But there's some nasties in there around bucket companies and corporate beneficiaries. Some of those things will make those strategies not as tax effective, and I think they will come as a surprise as that detail unleashes.
Okay, so I just want to pick up on something you said there, the word complexity. So what strikes me with so many tax changes and big tax changes, and even things like the standard $1,000 deduction, a lot of complexity, and a lot of complexity all coming at the same time. Now, one of the principles of a good tax system is meant to be simplicity. And with all of these changes collectively, it just seems we're going very, very much in the opposite direction. So that's going to obviously have implications for taxpayers and also tax agents and accountants and advisors. So for all of the members of the Institute of Public Accountants, there's going to be a lot of changes, a lot of work, a lot of working out what's going on. What kind of added pressure do you see for accountants and tax agents and IPA members coming out of this budget?
You're right. Good tax changes have to adhere to three principles: equity, fairness, and simplicity. You're right. Anything that's state-driven, grandfathering, uplifting of asset values, they all add to complexity as well as choices. When a choice is offered, and there are various choices, there's also valuations required. So there's a compliance cost in obtaining third-party valuations that for assets that don't have an immediate market valuation. You're right. A lot of this will be hard to digest, even harder to communicate. It does add more layers to a already complex tax system. Unfortunately, we live in a world of complexity and nothing's changed.
Would you say there were any hidden bombs or hidden gems in the budget?
Well, there is a new tax offset. It's for people that essentially work, and it includes sole traders, irrespective of the structure that you use. If you are receiving employment income, there will be a new offset. It's $250. That is a rebate, so technically that is $250 extra dollars in people's pockets. Combine that with the standard deduction, which has its own level of complexity. That was something that was muted that did come through on the night. Again, that relates to not this financial year, and there'll be a lot of confusion in the public domain around all these, I'll call them tax concessions. They'll think that they would apply for this tax year, so that there will be a level of communicating that these will apply in the next tax season, not the current one. And then there's also the CGT changes will impact on investor behaviour, and it's always difficult to preempt how individuals behave as a result. They try to anticipate behavioural changes. That's part of Treasury's job, but it doesn't always work that way. And in particular, negative gearing changes, sometimes the market does the opposite to what Treasury preempt, and we've seen that in the past. They have dabbled with negative gearing, and and that had to be reversed years later because it didn't have the intended outcome. And no one, hand on heart, will know exactly what the impacts will be. Certainly, investors in existing residential premises will be, they'll think about that asset class a little bit differently after budget night, because effectively any new contract after budget night, effectively tomorrow, you'll have you won't be able to offset your losses from residential, particularly those who borrow to buy residential premises, which is in the main, most people do that. They will not be able to offset those losses against their other income, which was one of the major benefits for negative gearing. You can only do that for new dwellings. So most investors will focus on new dwellings, and existing residential stock, you'll see a fall off in demand purely because you're taking those potential buyers out of the net, and it'll be interesting to see how that plays out in the marketplace.
Yeah, there's some commentators that are saying house prices may decrease by somewhere between 1% and 4%, which you would imagine, given the median price now in Sydney is 1.6 million, isn't necessarily going to be enough of a decrease to enable first home buyers to buy into the market, certainly not at that level. But I just wanted to ask you also, in terms of like good policy, we always talk about having evidence, evidence-based policy, rigorous cost-benefit analysis. Did you see any of that or much of that in the budget papers so far, or do you think we'll have more of that during the consultation period on some of these major changes?
Well, the government has a lot of political goodwill up its sleeve. These changes are being measured under the guise of intergenerational fairness. So what they're trying to do is reduce the effective tax rate that people with CGT assets or negative gearing to something that equates to a tax rate that applies to a salary and wage earner. So that's the basic metric that they want to be judged against. So under that guise of intergenerational fairness, they're using that metric to basically justify these tax changes. They're revenue positive. Some of that is being redistributed back to workers in the main, and the rest goes into general coffers. So that's basically what they're using. So not necessarily evidence-based. I mean, they have preempted changes. They're comfortable with those changes. They've preempted what it might do to house values. That's always a very difficult it's always difficult to preempt that difference it might make. That is subject to many variables. Interest rates in particular, I think it would be more sensitive to interest rates. But for existing stock of residential premises, if you eliminate buyers, that generally has a downward impact on the price. So I would expect existing residential premises, eliminating buyers will have downward pressure. How much by is anyone's guess.
Do you think the government may have overlooked the fact that approximately, more than 70% of landlords in Australia, has apparently around 2.1 million landlords, are also wage earners, the so-called mums and dads. So the same people who are investing in property are also wage earners. We're talking about, people seem to think that they're different cohorts, but the vast majority are the same people. So do you think that the government may have overlooked that and is sort of trying to give on the one hand but take on the other hand? Do you think that's something that might play out later on?
I think the government's been very transparent. It wants those who do not have property to have a better opportunity to buy in. So those with existing, they're not looking after those people specifically by these changes, but they have grandfathered, so they're not going to give the attractiveness of residential existing is going to be a little bit diminished as an asset class. It will have some impact on the value of those properties. So those who do have investments might be impacted indirectly, but the government's been very transparent. It wants those who don't have property to have a better chance at owning property. So I think under that guise, I think they're trying to address that intergenerational unfairness.
Okay, so leading into the budget, the IPA has been critical of the government in terms of fiscal responsibility.
Yep.
The spending, if you look at my EFO, is heading towards more than 36% of GDP. Do you think that in this budget, from what you've seen so far, the government's done enough to arrest that problem and to prove that it is being fiscally responsible?
Well, it hangs off the biggest sizable reduction in government spend, as most people would be aware, is NDIS. Now, that's going to be a difficult task because they haven't been able to achieve that to date. So that's a challenge. Government expenditures are at historic highs. The big elephant in the room is the fact that personal income tax still accounts for roughly 50% of the total take. So that unevenness in our tax base will carry forward, and that's I think the biggest opportunity lost. And it if you look at our media release, it highlights that particular issue has not been addressed, and that's something that will actually improve intergenerational fairness more than the sum of all these other measures.
So two last questions. Any particular message to IPA members?
We're going to have to deal with more volumes of pages in our tax system. So complexity and who pays for it. Will clients pay for this complexity is always a challenge for our members. They'll have to seek advice. Like I said, some changes are immediate, some changes will happen over the course of time. The attractiveness of discretionary trusts and moving into a corporate structure. Trusts have always been a target for Treasury, and tonight we've seen firsthand they have essentially going to close down a lot of some of the strategies that have been prevalent for quite some time, particularly bucket companies, but they're also offering the ability to restructure. We'll have to see what that is, but yes, the use of discretionary trusts and corporate beneficiaries or paying to low tax beneficiaries. I think those things will not continue, but they won't start until July 28. So we've got enough time to adjust to the new rules. So that's a pleasing aspect, and the other pleasing outcome is the instant asset write-off will be permanent, and loss carryback is another positive from tonight, particularly given the trading conditions. The ability to combine that with the instant asset write-off means that could be a saviour for a lot of corporate entities. So that is something that was pleasing. That loss carryback will be rejuvenated, and there's a specific benefit for startups, but it's tied to a metric that we haven't experienced to date, and that is it's capped to the amount of withholding on wages, something that is a new metric that we haven't used previously.
So, and you know, lots of complexity, lots of changes means that the need for a really good tax agent, a really good accountant, is even more imperative for everyone, for all taxpayers. So just, actually I'm going to make it my second last question. In terms of small business, were there any particular measures that you thought would be beneficial?
Yeah, the loss carryback applies, again, unfortunately applies to corporate entities only, and 3/4 of small business are not incorporated. So effectively, they don't get that safety blanket. If they've had a bad year, they can claw back. So that's always been the case. Loss carryback has always been restricted to corporate entities. That hasn't changed, so that's another missed opportunity. The instant asset write-off will be something well received. Not much else other than the that creation of that offset is really a tangible benefit. There will be some red tape reduction for small businesses. Other than that, not a lot that I could highlight.
Okay, so there's still a lot of work to be done for the benefit of small business, and you know, we'll have a better look at the detail around the government's productivity measures. We'll see if they make any real change. From what we can see so far, not a lot and not enough. I know there's changes to R&D, but we'll have a good look and we'll examine all of those. So my last question, and I want to just put you on the spot. If you were to rate the budget out of 10, no one will hold you to this, Tony?
Yes.
What would you give it?
Well, you know the phrase I use quite common, the elephant in the room. From that perspective, it hasn't really addressed the fundamental need to reform our tax base. That remains, and it will be a challenge for intergenerational fairness, and they could have done something more meaningful. So it's a lost opportunity. So I rate it quite poorly. Okay, I'll make that a 5.5 out of 10. Okay, thank you so much for your time, Tony, and thank you to all of our members and everyone else for listening. Bye for now.